Hey everyone, let's talk about the IRS Form 1040 for 2024 taxes. It might seem overwhelming at first, but with the right approach, it's much easier to manage than you might think. Today, I'll walk you through the form so you can file your taxes confidently and avoid common mistakes. So, Form 1040 is the main document used to file your U.S. individual income tax return. Whether you're using tax software or filling it out manually, understanding how it works is key to making sure your taxes are accurate and stress-free. Let's start with a quick overview. The form begins with your personal information: your name, address, social security number, filing status, and dependents. It might seem like just basic details, but getting this section right is important because errors here can slow down processing or even trigger an IRS notice. Now let's talk about calculating taxable income. This is where you report everything you earned in 2024: wages, salaries, bonuses, freelance work, and any other sources of income. The more accurate you are, the smoother the rest of the filing process will be. Flipping to page 2, this is where your tax liability is determined. You'll subtract any tax credits you qualify for and factor in the taxes you've already paid throughout the year. Think of it as balancing what you owe with what you've already contributed. At the end of the form, you'll see whether you're due a refund or if you need to pay additional taxes. Form 1040 helps you figure out if your withholdings and credits were enough to cover your tax bill. Now let's go through an example. Imagine John, a single filer working on his taxes for 2024. He's filled in his personal information, including his name, social security number, and address. He's checked the box for single as his filing status. There's also an optional box for contributing to the presidential election campaign, but checking it won't change your tax amount or refund. For anyone involved with cryptocurrency or digital assets, there's a specific section for that. The IRS requires you to report any buying, selling, or trading of digital assets. So if that applies to you, make sure you fill it out accurately. John didn't have any digital assets, so he checked no and moved on. Next, let's talk about dependents and deductions, since they can significantly impact taxable income. A dependent is someone you financially support who qualifies under IRS rules, like a child or relative. Claiming a dependent can lower your taxable income and make you eligible for valuable tax credits. The IRS has strict rules for this, including age, residency, and financial support requirements, so it's important to check if you qualify. John's situation is simple. He has no dependents and isn't claimed as one. If you do have dependents, be sure to list them correctly and claim any applicable credits. Now on to reporting income. John has a W-2 from his employer showing he had taxable wages for the year. If you have multiple jobs, freelance income, or side gigs, you'll need to gather all your tax forms, like W-2s and 1099s, and make sure you report everything accurately, including any estimated taxes paid. In addition to wages, you might have interest income. Interest can be taxable or tax-exempt. Tax-exempt interest, like municipal bond earnings, doesn't count toward your taxable income, but interest from savings accounts, CDs, or investments is taxable. John reported some taxable interest from his bank account, which was slightly higher this year due to higher interest rates. Next, we come to capital gains. This applies if you've made money from selling stocks, real estate, or other investments. A capital gain happens when you sell an asset for more than what you paid for it. If you sold for less, that's a capital loss. These gains and losses must be reported separately. John didn't have any, but if you do, make sure to check the instructions for properly reporting them. Then, adding up all his income sources, John calculated his total income. Since he had no adjustments, his total income and adjusted gross income were the same. But if you have adjustments like student loan interest deductions or contributions to a retirement account, you'd subtract those from your total income to get your adjusted gross income. Now, let's look at the standard deduction versus itemized deductions. The standard deduction is a flat amount that lowers your taxable income, while itemized deductions are based on actual expenses, like mortgage interest, medical costs, and charitable contributions. The IRS adjusts the standard deduction each year for inflation, so be sure to check the latest numbers for your filing status. John took the standard deduction because it was the better option for him. But if your itemized deductions add up to more than the standard deduction, it may be worth itemizing. He then subtracted the deduction from his income to calculate his taxable income. And using the IRS tax tables, he found his tax amount for that income level. Now, tax brackets shift slightly each year, so it's important to check the latest numbers. Based on his taxable income, John found the tax amount that applies to his filing status and entered it on page 2 of Form 1040. Page 2 also covers tax credits, which can reduce your tax bill. One major credit to be aware of is the child tax credit, which can be worth up to a certain amount per qualifying child. Tax credits reduce what you owe dollar for dollar, so it's worth checking if you qualify. John didn't have any credits, so his tax amount remained the same. Now let's talk about federal tax withholding. This is the amount already taken out of your paychecks throughout the year. John checked his W-2 and saw his federal income tax withholding. If you've switched jobs or worked multiple jobs, be sure to add up the withholding from all your W-2 forms. And for freelancers, gig workers, and anyone earning self-employment income, estimated tax payments are important. These payments help cover your tax bill if you don't have taxes automatically withheld. If you made estimated tax payments, be sure to report them accurately. John added up all the taxes he paid during the year, including withholding and any estimated payments. The total amount he paid was more than what he owed, meaning he overpaid. That brings us to the refund or amount owed section. If you've paid more than you owe, you'll get a refund. If you've paid less, you'll need to pay the remaining balance. John had overpaid, so he's getting a refund. He entered the overpayment amount and decided to have the full amount refunded. And to speed up the process, it's best to enter direct deposit information, since direct deposits are processed much faster than paper checks. Also, to avoid errors when filling out Form 1040, double-check your numbers, claim any deductions and credits you're eligible for, and make sure all sections are completed correctly. Some sections may not apply to you, and that's fine. Just leave them blank. So the example we just went through is a great starting point, especially for those with simple tax situations, like single filers with W-2 income and no dependents. But tax situations can vary. If you have multiple income sources, self-employment income, or more complex deductions, consider using tax software or working with a tax professional to make sure everything is accurate. And once everything is complete, sign and date the return, review it one last time, and file it with the IRS before the deadline. And that's it. Everyone's tax situation is different, so use this as a guide and check with a tax professional if you need personalized advice. Let me know if you have any questions in the comments, and don't forget to like and follow for more tax tips and updates.